There's a lot of online advice for entrepreneurs on how do you value your startup. Unfortunately, most of that advice is completely wrong. My goal in today's video is to give you advice on how do you value your startup regardless of where you are in terms of raising money, whether it's friends and family, angel funding, or venture capital funding. I'm going to give you advice on what do you do in each of those three scenarios and how you value your startup. I've raised over $100 million in venture capital and private equity funding, and I've helped entrepreneurs like you raise rounds of between $50,000 and $150 million. I've been around a lot of fundraisings. I know what works and I know what doesn't work. So let's get started. I'm going to break up the discussion into three groups of investments. The first being friends and family, the second being angel investing, and the third being venture capital investing. Now, if you're not already a subscriber, then hit that subscribe button right now, and you'll get notified every time I release a new video. Let's start with the friends and family round. This is typically how most of us get started. Either we have a small amount of money saved up, or we go to non-professional investors like our friends and our family, thus the friends and family, to raise money. That's why it's called a friends and family round. Typically, the round size for a friends and family round is somewhere between $10,000 on the low end and $150,000 on the high end, but it can be higher and it can be lower. Now, the question is, what should you value your company at? Now, I'm a big believer in always getting the investor to give you a price first rather than you offering a price. It's always smart in negotiation to do that. However, typically friends and family rounds are different because you're dealing with lots of investors all at once. Maybe 10 investors or more might participate in a typical friends and family round. And try getting 10 people to agree on anything on what the price is. It's just not going to happen. So what do you do in this particular instance? Well, if you're going to price your round, then you give the price first. So typically in a friends and family round, the price is somewhere below $1 million, $1 million on the high end, and somewhere less than that on the low end. So typically maybe $500,000 to $1 million, depending upon how much you're going to raise. So that's the typical valuation. So let me give you an example. So let's say you're raising $100,000. Then if you're raising $100,000 and maybe the valuation is going to be between $500,000 and $1 million, that means you're going to give up between 10 to 20% ownership in your company if you price your round. It's just simple math at that point, right? If it's $100,000 and $1 million on the top end, well, 100,000 into $1 million is 10%. Now, maybe you don't agree on a valuation, which happens a lot, or maybe you don't feel comfortable valuing the company at this point in time. There are options for you. Now, typically, this involves some sort of what's called a convertible note. Now, a convertible note means you're going to have debt which transfers into equity. But there's yet another option which has become even more popular, and I'm going to focus on this option for simplicity, and that's called a safe note. Safe notes were invented by Y Combinator in 2013. Now, you can go to Y Combinator's website and download all the information about safe notes there, but let me walk you through the basics right now. So the first step is investors and you agree to defer the amount of equity that they're going to get and you're going to give up until the next priced round. That's step number one in our process. The second step is investors agree that they're going to get a discount on the next round of funding. Typically, this is around a 20% discount. This is to reward investors for taking a bigger risk. Makes sense, doesn't it? They're getting in earlier, they should get a risk, they should get a discount on that next round. Now, the third step is the company agrees to set a cap on how high the price can go in the next round. Now, this protects investors again from getting diluted too much if the price goes too high. Now, if this content is resonating with you, then hit that like button right now. Now let's move on to angel funding. Typically, angel investors are high net worth individuals, and they want to invest their money and they want to give back at the same time. But make no mistake about it, they're in there to make money, and they have expertise in your particular area, which is why they want to work with you. They also may want to mentor you as well. That's very typical with angel investors. Now, the round sizes are bigger compared to friends and family. Typical round sizes are anywhere from around $100,000 to around $2 million. But again, they can be larger than this. Now, because angel investors are more like professional investors, the discussion of valuation is much more nuanced than with friends and family. So let's walk through it. So the first thing is unpriced rounds are still very common at this stage. So you can still use that safe note concept yet again. So if you're going for a priced round at this point and you're dealing with 2 or less investors, then try and get the investors to give you a price first. It's always best in negotiation. So if they're 2 or less, it's a manageable group of investors. Somebody's going to be the lead, probably in all likelihood in this particular instance. Let them price the round first. Always a good idea to do this because you can always renegotiate from there. Now, if you're raising money from more than 2 investors, then you're probably going to have to price the round. So if you're pricing the round at this point, there's a basic rule of thumb to use, but it's going to vary by market and by interest. The typical one is assume that for every round of funding, you're going to give up 20% ownership in the round, especially for early stage rounds. When you get to later stage rounds, that number will be less. But let's assume this is an early stage round. You're dealing with angels, so assume they're going to get 20% of the ownership in the company in this round. That's a typical number to go with. So let me give you an example. Let's say you're raising $2 million in this round of funding with angels. So we're going to have a pre-money valuation of $8 million, which means we're raising 2 plus 8, which means our post-money valuation now is $10 million. So what's the percentage ownership? It's 2 million divided by 10 million, which means they get 20%. So that's how you can look at that. This would be a typical amount to give in an angel round of funding. Now let's move on to venture rounds of funding. Now, a typical size round for a seed round can be anywhere from $500,000 to around $2 million for early rounds. Now, for later rounds, it could be hundreds of millions of dollars. But let's stay focused on those early rounds because that's what we're focused on today. So, what are the rules of raising money in an early round, a seed round, or a Series A round of funding? First, always let investors set the price because they have so much more experience than you do. You can leave money on the table if you set the price too low, and maybe you can cost yourself an investment if you set the price too high. So always let investors go first. That's rule number 1. Now, let's say investors push you and they say, well, what do you think the value of your company is? And they won't let up. And you say, well, you can price it. And they still won't let up. What do you say? Well, let the market decide. The market is them as investors. Now, typically that's a cue for them that you've been well coached. But let's say that doesn't work. So if that doesn't work, then give a range of values to investors, not just one price. And what do you base your range on? Base it on companies similar to yours. You can find a lot of information online and try using something like Crunchbase to help you because there's tons of information in Crunchbase. Okay, now what's a general rule of thumb to use for a seed stage round or a Series A round for percentage ownership? Again, that 20% rule works well most of the time. So use it yet again here if you need to as a rule of thumb. But the numbers can vary when times are tough or when there's more competition. For example, in the Great Recession, 20% ownership wasn't enough for investors. They wanted 40 or 50 to make up for the risk of investing. That's what happens when times are tough. Think of it just like interest rates. Now, here's my final tip. The most important thing I'm going to tell you today: before you raise money, hire an attorney with experience in startup investing. That's the most important thing you can do. That's the one lesson. If there's only one lesson you're going to take from today, take that lesson, because a good startup attorney who's done a lot of financing rounds has seen it all. They're going to know what's right. They're going to know what's wrong. They're going to know what should be in a term sheet. They're going to know what shouldn't be in a term sheet. They're going to protect you from terms that are going to be predatory and are more important sometimes than the valuation of the company, like liquidation preferences and things like that. All these things a good startup attorney is going to help you with. It's well worth the money. And do it before you get started, not when you get a term sheet. That's my final piece of advice. Take that piece of advice. Please take it. So what did you learn from today's video? Put your comments in the comments column below today's video. Now there's one more thing I have for you today. It's a free startup pitch deck template. It has all the slides you need in order for you to have a great presentation. And even better than that, there's a note section below each slide which tells you what to put in each slide and what not to put in each slide. All you need to do to get your free startup pitch deck template is click the link below today's video. Now, for more great content from me, all you have to do is just wait another 20 seconds and more great content is going to pop up. Now, if you want to subscribe to my channel, then just hit that subscribe button and you'll be notified every time I release a new video. I've really enjoyed speaking with you today. My name is Brett at brettjfox.com. Have a great day. Thanks a lot. Take care.